Amazon is worth over $1 trillion, and it's not that difficult to get a small piece.
哇，画了，画了。Hey, don't skip this video yet, Just give me 10 minutes of your time, and I will change your life. I will teach you how to earn 5 figures in 30 days, okay? Without a 5 to 9 job. People always say, buy, sell, high, low. But I can tell you, that's the worst advice you can ever get, okay? Let me teach you how you can earn big money from the comfort of your own home, just like my triple penthouse, semi-detached HDB mansionette. Come with me. Hi, my name is Warren Binford. As a multi-billionaire, trillionaire stock investor, it's important to see the big picture. I have an acronym just for you called FEI, FEI, just like how my stocks FEI. With this acronym, you'll be able to know the big picture. F stands for firms. Factors within the firm, such as the price and quality of products, the competence of upper level management, as well as its visions and strategic plans, will all affect the company's financial numbers. Next is E for economy. Changes in the local and global economy will impact firms all across the board. For instance, in the current COVID-19 pandemic, there has been a slump in general demand as consumers and businesses withhold their spending, and the consumer and investor confidence dips. This has negatively impacted all companies. Lastly is I for industry. Factors like whether the company is in a sunset or sunrise industry, whether it is growing or mature, as well as changes in things such as the price of raw materials, the level of competition, or the general demand for its products will all affect the company's profitability. So, before you learn how to fly, you must be able to run. How can you fail if you don't even know which company stock to invest in? Don't worry, I am here to teach you how to do that with just 3 tools: horizontal, vertical, and racial analysis. Let my expert money counter explain this to you.
So first, we do horizontal analysis to find out how the company is doing across financial periods. We look at 3 key things: dollar change, percentage change, and trend percentage. These analyses are measured by comparing the current year values against those of the base year. Percentage change is derived by dividing the dollar change with respect to the base period amount, so we can compare the absolute value changes for different accounts. The trend percentage alternatively gives us a percentage comparison. Analysis period amount over the base period amount times 100%. More than 100% indicates an increase, and less than 100% indicates a decrease. So simple. However, please be careful. There may be seasonal distortions. So what are seasonal distortions? Let me give you an example.
For example, because of COVID, Berry and Best Baking Company reported extraordinarily low incomes from $100,000 in year 1 to $10,000 in year 2 due to the high increase in home bakers. It may appear as if they had a 900% increase between year 2 and 3, when actually, ignoring year 2, net incomes within year 1 and 3 actually flatline, so don't be misled.
Now we move on to vertical analysis, which expresses each amount on the financial statement as a percentage of another amount in the same financial period. So we have component percentages. We take the percentage of the analysis amount divided by the base amount. Normally, in the balance sheet, companies will use their total assets as the base amount. And in the income statement, the revenue is the base amount. So you may be asking, why do we make everything percentages when comparing between different companies? This is to standardize financial reports into common size statements. So what are common size statements? Let me give you an example.
Comparing percentages helps remove dollar value bias. For example, Company Wayron earns much less than Company Binford when we compare their net sales for the same financial period. But wait, by deriving the component percentages, we now see that Company Wayron has a much lower percentage of expenses with respect to their net sales revenue compared to the Company Binford. So Company Wayron earns 47 cents profits for every dollar earned in net sales, while Company Binford only earned 27 cents. Thus, even though Company Wayron had a much lower sales revenue, you should definitely still invest in them as they are much better able to generate profits.
But don't take it from us. Take it from our most successful masterclass student to date. Oh look, he's there, working on his gains.
Sawadika, my name is Profitable. I was like you, studying for the better future. But then I found Warren Buffett and decided to follow him. Let me tell you what I learned from him in just one word: profitability. In order to tell if a company has the ability to generate profit, we can look at a few metrics. So let's start off with ROA, or return on assets for long, which is an indication of a company's ability to use its assets to create profit. You multiply NPM with TAT. NPM, or net profit margin, is further calculated by dividing net income with sales. You can tell if the company can create profit from sales, and it is an indication of the management's ability to control expenses to earn a profit. TAT, or total assets turnover, refers to the company's ability to generate sales from its assets and is given by sales over average total asset. We now move on to return on equity, or ROE. You take ROA times financial leverage. Financial leverage is given by the average total assets over the average total equity, and it measures the relative amount of debts and equity. ROE measures the company's ability to use equity to create profits and is calculated with net income divided by average total equity. Next, earnings per share. Net income over the weighted average number of shares outstanding. Lastly, cash payout ratio. It measures the percentage of earnings distributed in the form of dividends. But take note that low payout ratios may not always be bad. High growth rate companies generally have low payout ratios, as most of the net income are reinvested into the business. So remember what I told you about profitability and get rich like me. Oh, hello. No high liquidity. I was from Kowloon Street, Hong Kong, poor and starving. I found Warren Buffett. He teach me liquidity. Liquidity only need a few ratios. Very easy to learn. Liquidity measures the short-term ability of the company to meet continuing obligations as they arise. Short-term creditors such as bankers, suppliers are interested in assessing liquidity. First one, current ratio. This ratio is current divided by liabilities. Measures the ability of a company to pay current obligations as it becomes due. The higher the ratio, the more horsepower the company is doing. Quick ratio is quick assets over current liability. Measures the immediate ability to pay obligations. This is a more stringent test of short-term liquidity than the current ratio. Quick assets are readily convertible into cash. Inventories and prepaid expenses are not included. Inventories are not as liquid, and prepaid expenses are advance payment. You can't convert them back to cash. Working capital is the current asset minus current liability. It measures the excess source of cash over its upcoming users of cash. The company will be able to repay the creditors, which is important. This is basically what liquidity means. Operating cycle measures the time for a merchandising company to convert its inventory into cash. Therefore, Warren Buffett has taught me well. Thank you for listening. 唔該, I'm gonna go home now.
Hello. My name is Margaret So Fen Qi. If you're as young as me, right, you can spend your daytime going swimming and suntanning as long as you trade smartly. Solvency helps you to check if a company can be alive for donkey years. Very simple one. You can tell from their debt ratio and interest coverage ratio. Debt ratio is liabilities divided by asset. Interest coverage ratio is income level before income tax and interest expense divided by interest expense. To know if a company is prosperous, we got three methods. I chop tell you. Price earning ratio is current share price divided by earnings per share. Dividend yield is annual dividend divided by share divided by current price per share. Then we also have market to book ratio. Book value per share is shareholders' equity divided by the number of ordinary shares. And market to book ratio is market price per share divided by book value per share.
Now that you've seen the success stories, seeing is believing, right? Do you want to make big money? Now I know you're eager to learn more and see your stocks fly as high as an eagle. Very, very high. Oh, for only a limited time with limited slots at a very cheap, affordable price of $6,999.99. You can join my financial masterclass and gain financial freedom and earn passive income for the rest of your life. For those who act fastly, you will be very handsomely rewarded If you sign up before 31st February, you will get an early bird discount at only 7,900.
Hey boy, where's your mask?
Show me your visitor pass. Hey, you look very familiar. Oh, I recognize you. You're the investment gundu, right? Made me lose my house, my wife, my girlfriend, my boyfriend, and everything. Now I become security guard.
Don't run, come back. Oi, come back.
Hey, cameraman, don't run. You better stay here. Point the camera at me. At me.
Okay.
Let me tell you guys the most important thing that the gundu never teach you guys. And that is how to look out for red flags. Red flags are warning signs that trouble is looming. One red flag is a suspect movement of sales, inventory, and receivables. High sales will result in a rise in accounts receivable, and there should be a corresponding rise in inventory to meet the increase in demand. Another red flag is when earning or problem occurs. Also, look out for decreased operating cash flow or excess debt. The inability of a company to collect receivable is also a major red flag. Slow inventory turnover caused by inventory buildup or overstating inventory is another red flag. Only rely on financial statement analysis as a general guide. Many factors must be considered simultaneously before making any judgment. Please don't make my mistake. Hiya. Hey, don't run. I still got more to say. Come back, don't run.